Oh man, I'm beat. What a day. What a day. Is this market ever going to become less interesting? These last 2 weeks have just been insane. Looking forward to the long weekend. Crazy day. All right, let's do the disclosure and then we can look at some of these earnings reports real quick and talk about the market. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and a member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here's a position disclosure. I got back into a little bit of path in the down move today, and then the other new positions on there are UVIXI and VXX, both of which I was buying pre-market. UVIXI actually started buying even before the CPI number hit, and then was adding after on the way up. Adding on the way up. Cool. All right, so let's talk about it. Well, actually, first I want to see what's going on with these earnings reports. We got Upstart halted right now. A little unusual. Not the first time I've ever seen a company just halt in front of their earnings report. Apple used to do that sometimes. But yeah, a little bit unusual. So we're waiting for Upstart to resume trading. The guidance didn't look great from what I saw. So they beat on Q4 revenue, 140.3 versus 134.8. But the Q1 guidance here, estimated EBITDA loss of 25 million versus an estimated, they're seeing an EBITDA loss of about 25 million versus estimates of a $5 million profit. That's not good. And the Q1 revenue guidance is pretty light also. So I would assume Upstart gets smoked on that when they open it up, but we'll see. We got Robinhood out. What's good in the hood? Robinhood is up. Nice beat on transaction-based revenue. Net revs beat. So initially that looks decent. Airbnb. Surprised this isn't up more. Looks like it's down $10 from its initial spike. Granted, I haven't read the numbers. I just saw the buyback. So Airbnb to buyback up to $6 billion of stock. Not bad. I assume that's a new buyback for them. I assume they haven't had one previously, but I could be wrong on that. Love a good buyback. Looks like their fourth quarter loss per share was worse than expected. Revenue, fourth quarter beat. Adjusted EBITDA margin beat. Q1 rev beat. Yeah, not bad. Numbers looking pretty good there, I think, overall for Airbnb. Instacart, recent IPO. This thing has done absolutely nothing since the IPO. Look at the garbage looking chart. I mean, hasn't, it's not at 7 either, but not great. Instacart sees Q1 adjusted EBITDA ahead of expectations. It's trading down. Not seeing any of the numbers. Oh, we have Lyft out also. Forgot about Lyft. Lyft, 21% in the green. Revenue in line. Q4 adjusted net. Crushed it. Gross bookings, solid beat. A really solid move from Lyft. Will, I've been there. I feel like most of the time when that happens, it doesn't happen in your favor, but every once in a while it does. Oh, man. All right. Let's pop over to the market. Sort of pretty strong rally into the close. Wow, look at that tail. The downside tail into the 21 EMA just off the rally into the close. It happens sometimes on these days. Into the last 30 minutes, it looked like we were going to close on lows. And we had a pretty strong rally. So even with that rally into the close, we're still down 1.4%. I think we were down over 2% at a certain point in the S&P. The NASDAQ, same deal. Pretty strong rally into the close. The Qs closed above where they opened today, intraday. That's why that daily candle is green, which is impressive. And it's also from the rally in the last half hour. And even with that, Qs are down 1.5%. And then here's the whammy. IWM, gross. Gross. And also rallied a little bit into the close. Doesn't look like it rallied quite as strong as the Supervisor Qs did, but it was still it's like over a $1.50 rally into the close. Even with that, the IWM is down 4.1%. Just an absolute bloodbath for the Russell. Whew. All right. Let's try to figure out what this does to our market, right? So that SPY tail under the 21 EMA is super interesting. There's still a really big give and take to this market. Obviously we caught this big down move. I had been describing myself as increasingly less bullish, even to some degree bearish, and I was obviously positioned for it. Net short yesterday into the close, and then this morning, even into the down move, I was like heavily buying the VIX. But we still have to recognize that the market is in an uptrend. So I don't think we should get too excited on the bear side of the market here. Sorry, Dimitri. Maybe not too excited for the bear side of the market yet. But technically all this is just another pullback into the equilibrium area. And because we closed so strong in the last 30 minutes, you even have a downside tail on the SPYs and the Qs that look like they could be a potential pivot point for the market. If we're going to continue the uptrend, I mean, this is pretty much right in the spot, We had a pivot low on January 5th. We had a pivot low on January 17th. We had a pivot low on January 31st. Do we have a pivot low on February 13th? To be determined. The trend is absolutely your friend. And this is just the one I keep trying to, kind of get this message across where it's like, yeah, we have evidence here where we could see a really big VIX pop and that could coincide with a big market pull, especially if you get a hot CPI, and we certainly got a hot CPI today. But trends tend to last for much longer than people expect, and for the moment, our trend is still fully intact, and everyone should realize that. The trend on pretty much every time frame is still intact to the upside for the SPYs and the Qs. Small time frame, intermediate time frame, large time frame are still fully intact. And if you're just looking at the technicals of the SPY chart, you should be trying to be long off the day low. Qs, let's take a look at these Qs. Qs held up even better during the day today, which, makes sense. Hot CPI, higher for longer interest rates. It's going to negatively impact the IWM. It's going to negatively impact interest rate sensitive companies the most. And, we've talked this to death. But Apple and Microsoft and companies like that, it doesn't make a difference to them where interest rates are over the course of the next 1 year, to be totally honest, because they're locked in at extremely low debt that's, dated, 40-year paper for Apple at like 2% or something. So that's why they don't matter. It doesn't matter as much to them. And the Qs were, whoops, got the wrong chart up. This one's linked to my focus. So the Qs held in best all day today, but obviously are still down by a decent chunk of change. But it's the same deal. It looked just like the SPYs in a lot of ways. Technical pullback to our equilibrium zone after having been a little bit extended a couple of days ago. This could just be the fourth major pivot low of the calendar year so far, and the trend could be your friend, and it can continue higher. What else is new? The IWM is a little bit of a problem. We had just had this really strong 3-day rally in the IWM, and it was looking really good, and it was getting a little bit extended, but had gotten back above key levels. Got back above, what was the first one? 194? I think 194, 196, and then 198.50. We're above all three of them. And then this number came out and wrecked it. It's interesting because pre-market this morning, before the CPI came out, you're getting a continuation of the relative strength, relative weakness dynamic, the rotation dynamic that we have seen over the course of the last 3 trading sessions. Pre-market this morning, the Qs were giving follow through to the downside off the big upside tails that came in a lot of the semiconductor names. So I think prior to the CPI, the Qs were down like 0.6% or something like that, and the IWM was barely red, and that was exciting for the continued rotation trade. But like I say all the time, when you have these major economic numbers, um, it can just change everything in a real flash, in a real heartbeat, and that is exactly what happened. That relative strength dynamic, that rotation dynamic, was out the window real fast on a very hot CPI number this morning. The big thing that I was looking for today, and the big thing that I'm going to be continuing to look at over the course of the last couple of days, is the VIX. So, we spent a lot of time talking about the VIX recently and saying that this is the big thing that we need to look at. To give myself some credit, I had a really good trade and a really good call out in UVIXI and VXX, and I was just buying those products, say looking for a squeeze, with the thought process of, if we could really get above like $15 in the VIX, 14.50 to 15, that it could create like a virtuous feedback cycle of buying, of protection for the market that could just totally squeeze that higher. And we began to see that today, and it's right in front of this options expiration, which is a really big options expiration tomorrow, to see whether or not some of the big VIX calls that we saw over the course of the last couple months can actually close kind of in the money or not, and if they and it'll also be interesting to see if they just take some of that and roll it out to further dates, like March or April. So that was pretty much it, and I'm certainly like, look, it was a really good call. I do want to give myself some credit. In some ways, I almost feel like it was like one of the better calls I've had. But I don't want to give myself too much credit, because I'm not a genius. All I did was read the research. So everybody has the ability to read the research. It's been in the Pat's morning note. Bill provides a lot of that information also as well. So if you're just reading the information that's coming from these guys, then you understand the positioning that's out there, because we've seen the VIX calls come in. They were in Pat's note a lot when the calls were first coming in like a month ago. And again, they're in the data, and it's just what I'm looking at and trying to interpret to figure out at a certain point if a squeeze could come in, and where that squeeze could potentially come in, and how bad it could be. There's still a lower probability situation of just a really, really big move to the upside, especially if you can start to squeeze maybe some of those structured product ETFs of option selling that come in. And just there's so many funds, and it's just so much out there right now that's just been selling and selling and selling, and you could potentially squeeze those, and it could create. I mean, I didn't get to fully read the article, but I know Dimitri posted a Bloomberg article this morning that we're 6 years past the Volmageddon incident where the XIV ETF totally blew up. Not saying that is going to happen here. It's probably the lower probability situation. It is the lower probability situation, but it's a low probability situation with a very, very, very high payout. So it's kind of what I was looking for. And then from a timing perspective, it's like, all right, CPI right in front of this expiration. Maybe that can really, really squeeze things higher. And based on what I was trying to read from the data that's been coming from Charlie, however you say his last name, it seems like, if I'm interpreting this right, above 15, you start to get a lot more forced buying that kind of can come into that, as opposed to if we stay like below 14, then the actual opposite can potentially happen, where that stuff expires worthless, and the hedges that are out there have to come off, and if anything, that could enable the market to squeeze higher. So with where we're at right now, obviously we got a really big move up in the VIX today. I don't know what the high was or where we closed. If anybody's got that information offhand, otherwise I'll end up looking it up after hours. I think we got to almost 18 today. I think, did we close a little bit above a little bit below 16. Is that right? Close is 1585. The high is 1794. So yeah, I mean, I think that up here, the higher this VIX is able to go in the short run, the more it can actually potentially create a further squeeze higher. And at some point, you might be able to trigger a real problematic situation with all the option sellers that have actually been out there, and they could run into some real problems, and that could create an even significantly bigger move. So, I bought a boatload of UVixie today. I started buying it before the CPI. I was adding after the CPI. Then I started buying the VXX also on the way up. I was keeping it tighter, a little bit of a different game plan. Where with UVixie, I was basically in pure greed mode and basically not trying to sell anything. Whereas the VXX was a little bit more of my normal strategy and approach of looking to just sell bits on the way up and maybe buy it back on the way down. I did end up dumping some UVixie when Pat basically called out this big volume upside capitulation of this parabolic move in it. I finally was like, all right, I got to take some off. let me take a little bit off. Maybe I'll be able to rebuy it. And these products are just such garbage that there's a very real probability that I make, probably at this point, there should be almost no probability that I lose money in the position, but I'm just implementing it like kind of an all or none game plan, especially for this UVixie, where I have no problem making nothing in it. I want to be involved in this with a large position for a squeeze to at least $12, or I don't want to make really anything in it at all. And I'm totally fine with making nothing in it. And that's not necessarily the right game plan for other people. If anybody else was trading it with me, if you're trading around a core position, if you're booking profit, if you're selling it on the way up, that's probably the better move, to be honest, because eventually UVIX is going to make a new low. Whether that happens tomorrow or not, and the market's immediately resuming higher, or we get a squeeze, which maybe can lead to another squeeze, which can lead to another squeeze, that could give you, I don't know, an 80% move in this type of product. It is also possible, but I do think it's still the lower probability situation. But that's what I'm going for, and I try to never really trade these products because they're such garbage. But if you're gonna do it, you really have to time it right, and all the data was there to help us time it right, and then the CPI hit, and that was pretty much it. So for me, I'm just like, all right, I'm in and I'm going for it, and that's it. As opposed to my TQQQ and sock sell shorts, which I'm just covering on the way down and I'm reshorting on the way up, and I'm covering on the way down and I'm reshorting on the way up, and I'm working it because again, you look at the spies, look at the Qs at the end of the day, and you look at it in combination with this really important VIX data that's out right now. There is still a situation where this market can rip in either direction. There is certainly a situation right now where the VIX squeezes higher and the market probably gets hit further, loses today's low, and then we have to assess deeper pivots. But there is also a situation where that doesn't manifest, and it actually could really lead to just another perfect pivot low here that immediately, very quickly, is bringing us back to highs. So I am still in longs. I know that verbally I'm very focused on basically market short and VIX long right now, but I'm buying back and adding back into my longs, into the down move, into the gap down today. So I added to pretty much everything that I am long today as I was covering TQQQ and sock sell. Just the only unique difference compared to how I usually trade is even as I was covering the Qs and the semis on the way down, I was actually buying the VIX at the same time, which is interesting because it's like I'm covering my short bet while I'm adding a short bet at the same time, and I usually don't really trade that way for obvious reasons, I think. But that VIX trade is just a very, very unique trade in a unique situation. So we'll see how it plays out. But I really just want to emphasize that it's all in the data, right? And again, big shout out to both Pat and to Bill for consistently providing that data to us. Make sure as part of your morning research, at a minimum, you're reading Pat's note every day. Sometimes I don't fully get to finish reading it just because, I got 20 minutes before the meeting and positions are moving and everything else, but then go back and read it later. Again, it's like on the one hand, I want to give myself a lot of props for the way that I traded and the way that I bought these VIX products today. But on the other hand, I mean, how much props do I really deserve? All I'm doing is trying to digest this data, which I know can be super complicated and full of jargon and everything, and it's still a learning process for me. But all I'm trying to do is read that data, position myself according to the positioning data that we're seeing, which we spent a lot of time talking about in the past, by the way. And then I'm trying to reiterate what that thought process is in my head to you guys whenever we do these morning and afternoon meetings. But it's been consistently the same thing. I remember saying it when we called the bottom at the end of October, where it was also that we just, how are we able to call the bottom at the end of October so perfectly and say, hey, we're getting super, super long? It was the same thing. It was positioning data. And I think that positioning data is technical analysis, right? I know I did an afternoon meeting on that at some point in the past, probably in November when the market was actually ripping higher. But what is technical analysis? Technical analysis is the study of supply and demand in the market. And how do you implement technical analysis? Well, you do it by studying charts to measure that supply and demand. Well, I think that when you're looking at positioning information that we're able to get from various resources, but again, primarily is coming to us through Pat and through Bill, it is also technical analysis. It's just a little bit different. Instead of reading it in the charts, it's actually being handed to you in terms of, we understand in certain scenarios what certain systematic market participants are forced to do. VIX higher means that volatility funds have to sell. That's rather simplistic, but it's true. We get the data on CTA buying and selling, almost weekly. So it's the same thing. It's the same thing as technical analysis. Technical analysis, you're trying to study the charts to understand what buyers and sellers are doing or need to do in certain situations, or we're getting the data that's telling us what buyers or sellers need to do in certain situations. And obviously that's just certain cohorts, and sometimes they can offset each other, and sometimes certain things are more neutral, or they mean more or they mean less. And then it's also, the interesting thing to me is that I've always been a big believer for a long time that markets work in feedback cycles, where buying leads to more buying and selling leads to more selling, and that gets manifested in trends, right? And that's why into a potential pivot low, honestly, like what the market's given today, you want to be looking more times than not for trend continuation. But when you read the data on buying and selling, for the most part, it operates in the same way. Remember all of November, it was like the more the market goes higher, the more all of these market participants are forced to buy. Well, it's the exact same thing. It's just a feedback cycle of buying or selling that comes into the market that creates trends, and it creates big moves in one direction or the other, and eventually those moves capitulate and you can get the move in the other direction. But that's the majority of the time the market's moving in the direction in which it was already moving, and then a smaller amount of time the market is reversing the direction in which it was moving. Therefore, most of the time you want to be trading in the direction that the market is moving, and in other circumstances, Upstart trading down here, getting smoked. In other circumstances, when the data starts to pile up, we can look to say, hey, maybe we should be a little bit less aggressive right now on the continuation trade. And maybe we can open ourselves up a little bit more to being hedged, or to look for signals that can come in the other direction. And that's basically all that's happening once again now. And I think by, look, no trader is perfect. I am by no means perfect. No one here is perfect. And I will be wrong many, many, many times in the future. But I think that from like a big picture scenario, by combining an understanding of technical analysis in the charts with just all of the data that we're reading and kind of parsing through, it's enabled us to really pick every major high and every major low since the October 2022 bottom. And sometimes it's positioning in combination with extension. Sometimes it's positioning in combination with something technical, like the July high with that push through failure. But that's it's enabled us to be extremely accurate on big picture stuff, as far as knowing when to put your foot on the gas pedal, when to take your foot off it a little bit, and when to fully slam on the brake. So it's just a great job. It's a team effort, and it's enabled us to dissect the market in a way where if you can combine that with our fundamentals of understanding what a trade actually is, a technical reason with a technical out, a focus on risk management, and then a focus on good game planning for reward maximization, can enable you to be really profitable. So I think that's really all that I've got. Hell of a day today. Happy to answer any questions that anybody may have. So just give me one quick second. All right. Let me scroll up here in the VTF and see what's going on. Scrolling up, seeing a bunch of the earnings stuff, scrolling back down. From Bill here, I posted this yesterday AM. The S&P, what is W over W? Is it week over week? No. Up about 1.35%, a couple days of spot up, vol up. Upside offered in fixed strike vol from February out to April, with 10-day realized at 14. The fact that upside vol isn't trading up illustrates that dealers are not chasing upside. VIX expiration is on Wednesday, and there's a lot of February upside expiring. The record-breaking sweep from a few weeks ago. We have been seeing some March VIX calls going up, and expect more of those to come as February rolls. Yep, that's what I've been looking for also. So the expectation is for implied vols to have a reasonable amount of support with the fresh VIX call buying. That might be a reason why you want to own implied vol Vega more than Gamma. Yeah. Thanks, Bill. Thanks for all the information that you post. It's very helpful, even if sometimes... I tell you, over the weekend, last weekend, I was reading that note from Charlie again, which I had read like a quick read-through during the week last week, but I was reading his latest note like over the weekend without the market in front of me, and just like really trying to dissect all the pieces of information that are in there. And honestly, I'm doing it like in conjunction with like Google search to help me understand terms in more detail in certain scenarios. And it's definitely a lot of work to work towards understanding all of that, but it's also just super impactful. I mean, this is market structure. Market structure is what moves markets. So keep it up, Bill. It's much appreciated. You're making and saving me P&L at a minimum, and I appreciate it. Vixie Bull here is giving us our QQQ IWM update. Yeah, after a nice 3-day snapback in the IWM compared to the Qs, it's right back down real hard today. Candle faded. Thank you, Rich. From Paul. I've been trying to better understand why to build into a position and look for a spot to get heavier rather than just waiting for a spot to get heavier. Is it a timing issue? So let me reread that. You're trying to better understand why to build into a position and then look for a spot to get heavier rather than waiting for a spot to get heavier. Is it a timing issue? I think it, maybe to some degree is a timing issue. It's just that I think that perfect execution has become increasingly more difficult in the market, to be totally honest. And that's been ongoing for years now, and I think it's gotten even more difficult since all the zero DTE options and stuff came out. So, you know, if we were going to go back 10 years, I love the style of like momentum trading where you would do what you're describing, which is just wait for the spot. It's triggering. It's telling you to get heavy, and then kind of go for it. The problem now is that the market doesn't give that same, at least I find, like immediate follow through from like a momentum perspective, and you just have to be a little bit more looser in terms of your ideas on building in and building out, as opposed to just taking it all in one shot, putting that stop loss out for a big position size, and letting it go, especially if you're trading off the open. And I see it when I look at traders who are really, really good traders that I know who have been in the business for a long time, who are traditionally momentum traders in the style that I'm describing, who have actually been really struggling in some ways, for some of them, more than they ever have over the course of the last like year or two, because the market has changed in such a way that's negatively impacted their traditional approach to trading. And from my experience, the number one like killer of an experienced trader in this business is that the market environment changes in such a way that your edge doesn't apply in the same way that it has previously. So for me, for the most part, and there will definitely be exceptions, especially news and things like that. I have found, and I've even coached towards, like in phone calls and stuff, a little bit more one-on-one, towards some of these experienced traders I know who, like, I've had a few people tell me the same thing, and they've been in the business for a long time. Like, I'm buying all my position all at once, like I used to, right at that spot. I'm getting stopped out of my position. I'm taking a loss, and then next thing I know, after a bunch of ebbing and flowing, the market, works its way up, and my idea works, but I took the loss in it. And I just think that it's exactly what I'm talking about, and the advice that I'm giving those people as well. In the same spot where you used to take all your stock all at once and then put that tight stop loss in, how about you just take a percentage of your position and then watch it? Maybe put some more bids out, to build in where you're using the same dollar risk that you might have used initially, but take some initially, put some bids out, build into it, end up using a stop loss that's a little bit wider, but it's going to be the same, P&L risk loss roughly as it would be otherwise, and let the idea play out a little bit more than just the straight momentum execution stop loss style that's worked for so many people for so long. And I think that advice for the people who have been able to adjust to it has helped them. So I just think it's a function of how the market trades. You get, especially on very small time frames, just like a lot of these like shakeouts and pushouts and things like that, and then they kind of go. And look, other times you don't. Like, one thing I wanted to mention today, actually talking about almost getting stopped out of positions and not, was how close I was to getting stopped out of my VXX position at this low here at 1150, because this is the one that I wanted to keep, a lot of stock, but do it tight. So I bought this later than I bought UVIXI, which was buying pre-market. I bought this after the market actually opened. I bought it on like the 955 bar, I think, or maybe it was the 950 bar. It was the 950 bar. It was when this inside 5 broke up, and I just bought it versus this low, and the 80 MA wasn't even quite there yet. But I still, so the stop that I was looking at was 65 cents. The low is 66 cents. This pullback here is 67. So I got lucky there. And I get stopped out by 2 pennies on this VXX, and then it obviously ripped for $2 from there. But yeah, I hope that answers your question, Paul. I hope that helps. Teamwork makes the dream work. Yeah, use ChatGPT. I have been also a little bit. I've been using both Google and ChatGPT. Yeah, thanks, Bill. Appreciate it. From Tate, how do we know if these contracts get rolled over And does this trade get more complicated if they don't get rolled over or finish in the money? I mean, we won't know for certain, but we'll see the large order option flow come in, and if they are similar to what's expiring in February, then you can assume it's the same players that are just rolling their orders out a couple months. You can never know with 100% certainty, but that would be the assumption that we go with. Does the trade get more complicated if they roll it out? Not necessarily, not in the short term for what it means for us right now, but it kind of repeats the potential of the exact same situation as we go into mid-March and mid-April. I'm going to circle back to Eli's question from Rich. So the TQQQ flushed the February 5th low. Stops of 55.57 today. Feb 5th low. Okay. But the Qs did not get below that. Interesting. Why is that? It's the decay of the product, right? So the TQQQ, just being a levered ETF, is going to have decay, which in the long run makes it underperform what the QQQ itself will actually do. So what you're telling me here is that the Qs held the Feb 5th low, but the TQQQ did not hold the Feb 5th low, and it entirely has to do with the decay of a 3x levered ETF. Thanks for the question and comment there, Rich. Going back up to Eli. Derrick, I want to walk us through how you began increasing size as your career continued, and how might you recommend newer guys do it based on the modern market and what I've learned. Sure. So thanks for the question. So basically, the question it's kind of a two-part question. It is asking me about how I learned to size up in my own trading, and it is also basically asking me, and this is actually makes it a very smart question, because maybe the way that I sized up 15 years ago when I was new in the business isn't necessarily what I would recommend to people now, and that's exactly the truth. So the way that I sized up my trading when I was new is a way that I 100% do not recommend to people, but it's what I did. When I started with T3 Trading Group as a prop trader, I put in the minimum capital contribution with the company, and then outside of that, I had some money saved up to cover my life expenses. They gave me initially a 200 share max position size, and what I did was every single week that I finished with green P&L, I added on, I think 100 shares, might have been 200 shares, to my maximum tier size. So just every week I was positive, I just added to the tier size. There's multiple problems with that. Problem number one for me was I got too big too fast, to be honest. I was a new trader. I was trading very small, but I was stringing together a lot of green weeks, and then next thing I knew, I was sizing myself up from 200 shares to 300 shares in a relatively short period of time of actual professional trading, and it was way too big, way too fast. So I don't think that was the right way to do it. And then two is that for me, this second part didn't matter as much as a new trader because of the way that I traded. But I think that the market is very different now. So tier size isn't what matters. Tier size is not what matters. Risk is what matters. How much dollar risk are you putting into a trade? Meaning, I could buy 1,000 shares and give it 10 cents. I'm risking $100. I could buy 100 shares and give it $1. I'm risking the same $100. So is giving yourself more and more tier what matters? No, it's giving yourself more and more overall dollar risk. Now, the reason why that didn't really matter to me very much as a new trader was because of the way that I traded. Most of the time, almost every trade that I was taking, regardless of the stock that I was trading, unless it was a very expensive name, I probably had an average of 10 or 12 cents worth of risk. So inherently, just by increasing my tier size, it was proportionally increasing my dollar risk because I was staying with the same risk amount pretty much always, in the particular types of trades that I was focusing on at that time. Trading now, I think for new traders is very, very different. Maybe you're finding a trade where you're risking 10 cents. Maybe you're finding a trade where it's 20 cents. Maybe it's 50 cents. Maybe it's 75 cents. You probably have a lot more skew on your spacing risk, the difference between your entry price and your stop loss nowadays for new traders than when I was a new trader. So what matters now, and what you want to think about when you're sizing up, is the overall dollar risk that you're putting into your trades, because tier size is a function of the dollar risk that you're looking to trade and the space risk that the trade is requiring you to implement in order to trade it properly. In other words, the amount of shares that you take in any given trade is the last part of the equation of placing the trade itself. The first part is, okay, if I'm going to enter this trade now, where does the stop loss have to be, right? And just using the simple example from me today, I'm buying this inside 5 and up in VXX. I'm saying that my stop loss should be the low of the day at that point, this pivot low at 1466. So I think the price that I bought was 1478 or 1477. So I've got 12 cents worth of spacing risk. So that's the first thing that you ask yourself. The second thing that you ask yourself is, well, how many dollars should I be risking, right? And in this case, every 1,000 shares that you take is going to be, if it's 12 cents risk, $120 worth of risk. So are you a trader where this trade calls for $100 worth of risk? Then you should be taking 800 shares or so. Are you a trader where you should be putting on $250 worth of risk? Then you should be taking about 2,000 shares. Are you a trader where you should be putting on $500 worth of risk? Then you should be taking 4,000 shares or whatever. So that is how you come up with your formula of trading and how much tier size that you take. The tier size is the last part of the equation. So when you want to think about sizing up as a trader, what you want to be sizing up isn't your tier size, it's the dollar risk, right? And if it's the same dollar risk, then that will inherently mean more tier size. So if maybe 6 months ago you were taking trades with an average of $100 worth of risk, then you were taking 800 shares. 6 months later, you've sized up enough where it's $250 worth of risk, and now you are taking 2,000 shares on the position. The key to doing this is to size up small and incrementally over time based on success. So like the numbers that I just said in my example, I specifically said maybe 6 months later, you should not be making massive dollar risk jumps in short periods of time. You should not be, well, today I was profitable risking $100 a trade, so tomorrow I'm going to risk $250 a trade. It's way, way, way too big. And I don't know exactly what the percentage is, but, a few percent or 5% or something like that, maybe after every profitable week, you can add on, right? So I don't know if last week you were risking $100, maybe this is even too tight, but if last week you were risking $100 on average per trade and you were positive and you want to add on 5%, then now you're going to risk $105 per trade. Again, maybe that's a little bit too tight. But that's kind of the general idea. You don't want to size up too fast because the numbers become crazy for you and you'll make mistakes. Sizing up too fast can be a really big mistake for a couple of reasons. One is that if the numbers get too big, you're much more liable to just freak out because, oh my God, I'm going to lose, $500 in this trade. I've never lost more than $200 in a trade before. And now you're just freaking out, and as soon as you see that you're down 350, you're liquidating the position too early and not following your game plan. So one is that if you size up too big too fast, it can just cause you to make mistakes in your trading, and that's more from a psychological perspective than anything. But two is that you don't want to size up too fast, because if you had a couple good weeks in a row and now on week 3 you're sizing up at 300% compared to what you're doing, you could erase weeks or even months of really good work in a very short period of time just because you sized up so fast, and maybe that's even you traded well and just the probabilities were against you that week or whatever, and you happen to throw up a negative week. But you don't want a negative week as you're sizing up to erase 2 months worth of positive work. So size up size up small and incrementally over time based on success, and to some degree based on your account size. If you're adding on larger percentages of risk per trade, you should probably be working with a somewhat proportionally larger account. Smally, which is also why, for traders who are successful, especially if you're dealing with an account that's a little bit smaller, you want to do your best to not just withdraw all your profits every single month, and obviously that's totally up to you what you do as a trader. And there's nothing wrong with paying yourself, but you want to balance, I think, paying yourself and sizing the account up, because sizing the account up is a great way to add additional scale onto what you're doing. Because otherwise, if you're just working with the same account value, but your risk numbers keep going higher and higher and higher, the proportion of risk on a day or risk on a trade versus the account size could become skewy, and then the math again is wrong. So appreciate the question, Eli. I hope I covered what you need to know. Happy to help with any follow-up questions. Bill here posted the VIX. I think I remember you mentioning this VIX trade when it actually hit. This was an interesting VIX trade. The big sweep everyone was talking about was 10 million, and this is 7 million. It kind of looks like it could be a roll with the size being so outsized. The vol flow I normally post is 500,000 to 1.2 million. That's good for reference. And then, and those are the largest orders. So 7 million definitely sticks out. Yeah, interesting. So $18 calls for May. 7.76 million in premium. Big boys. The big boys. Cool. Scrolling down here from Rich. So if we feel ready to change your tier size up, then we should consult our Class B members first. It depends. It depends. Not necessarily. If you need increases to your risk parameters on your trading account, then obviously you have to contact your Class B member. But if you're incrementally sizing up in a small way into a new week or something like that, I don't think that you necessarily need to have a conversation with someone about it, as long as you're doing your own appropriate analysis. Cool. All right, looks like I covered everything in the VTF for the moment. Yeah, Upstart is out. Down to 25 bucks. See ya, 30%. Bye-bye. Is SoFi moving down on that? It's not. I'm very glad to see that. No problem, Sharir. Back to from Robert in YouTube. Back to your why. So I assume that means yesterday's comment about the VIX. With today's elevated VIX, don't you feel like the market should have sold off more? I mean, we're down 5% in the IWM. At a certain point, it's a pretty big sell-off. In some ways, maybe, yeah. but it's not a one-to-one correlation, you know, between the market and the VIX. So we'll see if that VIX can stay elevated and if it applies more weight onto the market over time. Joe in the VTF is asking me, what about China? Yeah, you know, nothing new. I think in China, in the Chinese names, they're staying a little bit weak for the moment. We're sideways, and you know, JD's in its range, Bob is in its range, Baidu's in its range, FXI is in its range. So we're just still waiting to see if China can put things together or not, and see if this snaps up or not. I still got my Baba long, I still got my JD longs. I got no problem with these things ranging because I sell into the pops, I rebuy the stock on the dips, and I just keep creating cash flow for myself pretty much every day in this Alibaba while I wait for a potential move. And yeah, what PMD Trading is saying here, it's the Chinese New Year holiday, so they're closed for this entire week. So Happy New Year, Year of the Dragon. Thanks for the question, and YouTube Joe. Oh, Hong Kong opens tonight. I didn't realize that. It's good to know. So that'll probably impact the ones with the Hong Kong listings. All right, cool. Looks like I got through everybody today. So appreciate everybody, you know, being here and tuning in. I hope you guys are making money and learning and doing well and putting what you learn into practice. So keep it up. Have a great night, everybody. I can't speak anymore. I need a good night's sleep. Have a great night tonight, everybody. I'll see you all tomorrow.